Welcome to today's deep dive. It's July 15th, 2026, and we're looking at a market where, well, the U.S. economy is basically brushing off a massive Middle Eastern war.
Yeah, just completely ignoring it.
Right. But then India is actively drowning in that exact same conflict. And meanwhile, a multi-billion-dollar World Cup couldn't even make the U.S. consumer flinch.
It's wild. It completely shatters this illusion we have that global markets operate on some neat linear track.
Oh, absolutely.
Because if you're just looking at a ticker symbol moving up or down today without understanding the localized cross currents beneath it, I mean, you are basically trading blind.
You really are. So today we are holding a massive stack of sources. We've got a comprehensive briefing on the daily U.S. stock market, the overall health of the global economy, and crucially, the underlying supply chains that are dictating the entire tech sector right now.
There is a lot to get through today.
There really is. Our mission today is to cut through all the noise of these fluctuating indices and decode the actual narrative driving your portfolio right now, because it's a lot.
It is.
We're going to connect the dots between these global geopolitical tensions, some highly unusual inflation data we just got, and this massive fundamental rotation happening in artificial intelligence.
Yeah, that rotation is the big story.
So, okay, let's unpack this. Starting with the macroeconomic ground we are all currently standing on.
Right.
Because before we can even touch a single stock, we have to address this incredibly fractured global web.
And fractured is definitely the right word for it.
Yeah.
Oh, yeah. The macro environment today is just heavily dictated by geopolitics, specifically energy markets. But the thing is, the shockwaves are hitting different regions in completely asymmetrical ways.
Right. So let's look at the U.S. first, because we have some deeply counterintuitive data here.
Very counterintuitive.
Right. So annual consumer prices, the CPI, rose 3.5% in June, but wholesale prices unexpectedly dropped 0.3%.
They went negative.
Exactly. Not just cooled off, but actively went negative. And our briefing attributes this directly to a massive decline in gasoline prices, which stems from, well, a brief pause in tensions between the U.S. and Iran.
Yeah, which just highlights how tethered domestic U.S. pricing is to minute-by-minute geopolitical risk premiums right now.
So true.
I mean, that drop at the pump, it didn't come from some brilliant new domestic policy, right? It came from a temporary diplomatic breather.
A pause.
Exactly. A pause that allowed global crude markets to finally exhale a bit. And that immediately passed through to U.S. wholesale prices.
But see, here is where I struggle to make the math work.
Okay.
Oil is a globally priced commodity, right?
All right.
So if a pause in U.S.-Iran tensions lowers the price of a barrel of Brent crude, shouldn't literally every country get that exact same deflationary relief?
You would think so, yeah.
Because when I look at India, their inflation just accelerated to 4.38% in June.
Yeah, blowing past all the forecasts.
Exactly. And the briefing specifically cites food and energy spikes tied to that exact same Iran conflict. So how does the same war cause wholesale prices to drop in the U.S. but act as this, like, inflationary accelerant in India?
Well, it comes down to the mechanics of structural vulnerability, really.
Yeah.
And currency.
Okay, unpack that for me.
So the U.S. is a massive domestic producer of energy, right?
Mm-hmm.
It has immense refining capacity and a built-in structural shock absorber.
Right. We produce a lot of our own oil.
Exactly. India, on the other hand, imports the vast majority of its crude oil. But it's not just about the pump price for them. It's about the compounding effect.
Ah, okay.
Because of the briefing notes, India is currently suffering from severely deficient monsoon rainfall.
Right, a drought, which obviously devastates agricultural yields.
Exactly. But think about the mechanism of how farmers adapt to a drought over there.
How so?
When the rains fail, Indian agriculture relies heavily on diesel-powered groundwater pumps for irrigation.
Oh, wow. I didn't even think of that.
Right. So a spike in global energy prices directly and immediately inflates the cost of domestic food production.
Because they're burning diesel just to water the crops.
Exactly. So you combine an energy shock with an agricultural crisis, throw in a depreciating local currency against the strong U.S. dollar, and India's inflation compounds in a way the U.S. simply doesn't experience.
It's like macroeconomic whack-a-mole, or like a waterbed.
A waterbed, yeah, that's a good way to look at it.
You push down on U.S.-Iran tensions, and the U.S. gets a breather on inflation, but the water sloshes over, and India still feels the heat from the exact same conflict.
Exactly.
And then, okay, we pan over to China, and they just posted their slowest quarterly growth since 2022.
Yeah, missing Beijing's 4.5% to 5% target range entirely.
Right.
It's a structural slowdown in the world's second largest economy. driven by entirely different domestic real estate and, consumption factors.
Well, speaking of consumption factors, there is a detail in the Fed's latest beige book that I found absolutely fascinating.
Well, World Cup.
Yes, the World Cup. The beige book highlighted that the massive influx of spending surrounding the World Cup did not translate into broader U.S. economic growth.
Yeah, that surprised a lot of people.
Because, I was out in the city during those matches.
I'm sure it's packed.
It was crazy. The sports bars were packed, shoulder to shoulder. People were buying jerseys, upgrading their televisions just to watch the games.
Right.
How does an event with that much localized velocity fail to move the needle for the broader economy?
Because, well, we are operating in a highly constrained, high-interest rate environment.
Okay.
What you're describing is the classic substitution effect.
The substitution effect.
Yeah. When consumers don't have cheap credit to just, expand their overall spending pie, they just slice the pie differently.
Oh, I see. So they aren't spending more money overall. They are just diverting it from somewhere else.
Precisely. If a consumer drops, say, $1,000 on a massive watch party and a new television for the World Cup, they are likely delaying the purchase of a new refrigerator.
Right. Or they aren't taking that domestic flight for a weekend vacation.
Exactly. The economic velocity didn't multiply, it just shifted sectors. The total discretionary budget of the U.S. consumer right now is essentially capped.
That makes so much sense.
Right. And if we connect this to the bigger picture, you start to see why institutional money is behaving so defensively right now.
Because everything is so fragile.
Exactly. You have a tapped-out consumer, a Chinese economy missing its targets, and an inflation dynamic that is entirely at the mercy of whether or not a missile is fired in the Middle East on any given Tuesday.
Which is incredibly stressful if you're managing billions of dollars.
Highly stressful. Which is why the market is holding its collective breath ahead of the European Central Bank's interest rate decision next week. Capital is just seeking shelter from all this unpredictability.
And that search for shelter is violently reshaping your portfolio today.
It really is.
Because all of this macro fragility we're talking about is triggering a massive sector rotation, investors are basically fleeing the hype of the last 2 years and running full speed toward ironclad fundamentals.
Let's define what that actually looks like in practice, starting with who fundamentally benefits from a prolonged high-rate environment.
Well, the major U.S. banks, for one.
Right.
Like J.P. Morgan and Goldman Sachs are expected to post very strong numbers this earnings season.
Because banks inherently benefit from wider net interest margins when rates stay elevated.
They charge more for loans.
Exactly. They charge more for loans while keeping the yields they pay on your deposits relatively sticky or low. Plus, with capital markets and M&A activity showing signs of life, because companies are finally accepting that rates aren't going back to zero anytime soon.
Right, the zero interest era is over.
It's over. And so their investment banking arms are finally re-engaging.
But the real violence in this rotation is happening in the tech sector.
Yeah, it's pretty brutal there.
The semiconductor index fell 2.1% today alone. Micron, which is a massive player, plummeted 8.15% in a single session.
That's a huge drop for a company that size.
Right. And yet, if you look at the top gainers today, Apple is up 4.01%, Meta is up 3.07%, Amazon is up 3%, and Microsoft is up 2.78%.
The mega caps.
Yeah, and I need to push back here because this feels totally contradictory to me.
How so?
If investors are spooked by macro uncertainty, why are they dumping semiconductor stocks but piling into Apple? Aren't they both just tech stocks?
Well, yes, but...
I mean, how is parking money in a $2 trillion tech giant considered a safe defensive move?
It's a phenomenal question, and it really comes down to the difference between capital expenditure and cash flow.
Okay, break that down.
Investors are rotating out of crowded, speculative AI trades, like the hardware companies that require billions in debt just to build the future, and they are seeking safety in the mega caps that already own the present.
Ah, I see.
Apple isn't viewed as a speculative tech growth stock right now. It's viewed as a fortress balance sheet.
Well, let's do a deep dive into Apple's numbers then, because the briefing points out a historic anomaly here.
Yeah, this is super interesting.
Apple stock had fallen roughly 30% from its July 2025 all-time high.
A massive haircut.
Right. And because of that haircut, Apple is now trading at less than 20 times forward earnings. It has actually dipped below the broader S&P 500's multiple, which currently sits at 21.7x.
You really have to think about the magnitude of
That's
that.
crazy.
Historically, the market pays a massive, massive premium for tech monopolies. But right now, You can buy into Apple's ecosystem, their cash reserves, and their massive share buyback program for a cheaper multiple than the average industrial or consumer goods company in the S&P 500.
So what does this all mean?
Well,
It means this isn't a tech sell-off at all. It's a bargain hunt for value. Investors are demanding that the math actually makes sense today.
and this raises an important question. Are we finally seeing the end of the blind AI gold rush?
The honeymoon phase is over.
It's exactly. For the last couple of years, any startup or hardware manufacturer that just bolted the letters AI onto their earnings call saw their valuation completely detached from reality.
Oh yeah, it was wild.
It's a pure narrative trade. You were buying the story of 2030.
But with capital costing 5% to borrow now, and the Middle East actively threatening global energy supplies, nobody wants to finance the story anymore.
Nope. They want proven revenue streams, unassailable margins, and massive defensive cash piles.
Which transitions us perfectly into this stark reality check happening inside the AI sector itself.
Yes.
Because the latest earnings reports are exposing a massive, just undeniable split between the software layer and the hardware layer.
The divergence in how these two sides are being valued right now is staggering.
Let's start with the software and cloud side.
Okay.
Microsoft's fundamentals are absurdly strong. Cloud computing growth is up 40%. Overall revenue is up 18%.
Huge numbers.
But the number that really jumps off the page, their AI revenue is up 123% year over year.
Yeah, that's the real proof right there. Triple-digit growth in a new product category by a company of that massive size. It proves that enterprise adoption of AI is not some future theoretical thing.
Right. It's happening right now.
It is a line item on
Right.
corporate budgets today. Microsoft is successfully monetizing the technology right now.
But then you look at the hardware and infrastructure side, and it is a completely different mood.
Completely.
Companies like ASML and TSMC are facing intense investor scrutiny as this Q2 earnings season kicks off. And let's be precise about who is doing what here for you listening.
Good idea.
ASML is the company that makes the extreme ultraviolet lithography machines, the highly complex $300 million printers required to make advanced chips.
Right.
And TSMC is the foundry. They buy those machines to run the massive fabrication plants that actually bake the silicon.
And both of them are feeling the crushing pressure of their own hype right now.
Yeah, they are.
The market expects them to grow perfectly into their sky-high valuations. But building physical infrastructure is a brutal business in a high-rate environment.
Right, because a software company like Microsoft builds an AI tool once, flips the switch on the cloud, and scales it to 1 million enterprise customers with near infinite margins.
Exactly. Whereas TSMC has to forecast demand 3 to 5 years out, borrow billions of dollars a day at elevated interest rates, and physically build a fabrication plant.
Which takes years.
Years. And if enterprise demand for AI cools off even slightly by the time that factory comes online, TSMC is left holding a catastrophic amount of debt and unused capacity.
Ouch.
Yeah. The CapEx burden, the capital expenditure required just to stay in the game, is terrifying investors.
So they see the cash today with Microsoft, but they only see the massive expense today with the chip makers.
Precisely. What's fascinating here is that to justify those valuations, the underlying technology has to become radically more efficient.
Which brings us to the next frontier of this deep dive.
The metric of success in AI hardware is fundamentally changing.
Right. Our sources highlight that NVIDIA is facing intense new competition, and the new battleground metric isn't raw computational speed anymore.
No, it's not.
It's something called tokens per watt.
A critical pivot.
Yeah.
Let's explain that. A token is essentially the basic unit of data an AI model processes.
Okay.
So tokens per watt measures how much actual computational work a chip can execute for every single unit of electrical energy it pulls from the grid.
Here's where it gets really interesting, because this feels exactly like the evolution of the commercial airline industry.
Well, that's a great comparison.
Right. Back in the 70s, the Concorde was the coolest thing in the sky.
Oh, yeah, supersonic.
It was all about raw, brute force speed, Mach 2, but it burned so much jet fuel that it was a commercial disaster.
Right.
The airlines quickly realized the real money wasn't in raw speed, it was in the Boeing 787 Dreamliner, a machine engineered from the ground up to optimize every single square inch for fuel efficiency and range.
Exactly.
That is where we are with AI hardware right now.
That is a perfect analogy. The first wave of AI was the Concorde. Massive data centers, incredible power consumption, just brute forcing the math to prove the models actually worked.
Just burning through power.
Exactly. But as these models scale up to serve billions of queries a day, You can't afford to run a fleet of Concords.
No, you'd go broke.
Your energy bill will literally bankrupt the data center. The margin compression forces you to engineer a dreamliner. You need the absolute maximum tokens per watt.
And the urgency for that efficiency is skyrocketing because the software just keeps advancing. The briefing notes that Maravi's thinking machines just hit a massive milestone, releasing its first AI model for broad public use.
Which means exponential increases in daily active users.
Right.
Which means an exponential load on the physical compute infrastructure. If the hardware doesn't win the tokens per watt war, the physical energy grid simply won't be able to support the software's ambition.
The grid will just tap out.
Exactly.
And it isn't just the physical hardware that is being forced to evolve and become more efficient. The actual financial plumbing of the market is shifting with it.
Yeah, this was huge.
Yeah. This was one of the most surprising details in our stack of sources. Securitize and Cantor Fitzgerald are currently developing a framework to support blockchain-based initial public offerings.
The tokenization of public equity is a fascinating leap for capital markets.
But, why now? Why mess with the traditional IPO process? You know, the investment banks, the road shows, the ringing of the bell on Wall Street, that has worked for decades.
Because just like the AI chips, the traditional IPO is a Concord. It is incredibly expensive and inefficient. Traditional underwriting takes a massive percentage fee out of the capital being raised, the lockup periods are rigid, and the settlement process is totally antiquated.
So how does a blockchain IPO actually fix that?
By utilizing smart contracts on a decentralized ledger.
Yeah.
So Cantor Fitzgerald provides the regulatory bridge. They ensure the offering is legally compliant, while Securitize builds the tokenized capitalization table.
Okay, so it's digital.
Right. Instead of waiting 2 days for a stock trade to settle through a centralized clearinghouse, blockchain equity settles instantly. Furthermore, compliance is programmed directly into the token itself.
What does that mean?
The smart contract can automatically verify if a buyer is an accredited investor before even allowing the transaction to execute, stripping out entire layers of costly middlemen.
It essentially lowers the cost of capital.
Dramatically.
In a world where interest rates are punishingly high and tech companies need billions just to build out this AI infrastructure, they are actively looking for a cheaper, more efficient way to raise money from the public markets.
It is efficiency driving innovation across the entire stack. I mean, from a microchip sipping a fraction of a watt to a decentralized ledger instantly settling a billion-dollar equity offering.
It's all connected.
It really is.
So let's pull all of these threads together and look at the whole board. We started by mapping a deeply interconnected macroeconomic web.
Right.
We saw how a localized pause in the U.S.-Iran conflict immediately cooled U.S. wholesale inflation, even while that same overarching conflict, combined with a monsoon drought, ravaged India's domestic food and energy prices.
And we established that the global consumer is highly constrained, evidenced by that World Cup substitution effect we talked about. Right. And that institutional capital is highly defensive heading into next week's European Central Bank rate decision.
Which perfectly explained the violent market rotation we are witnessing today. Investors are demanding immediate cash flow and safety.
Yep, they want sure things.
They are abandoning the speculative, debt-heavy AI hardware sector-cratering companies like Micron and bargain hunting in mega-cap fortresses like Apple, which suddenly found itself trading at a rare discount to the broader S&P 500.
And within the AI sector itself, the market is severely punishing the capital expenditure burden of hardware giants like TSMC, while heavily rewarding the immediate cloud monetization of software leaders like Microsoft.
Which is forcing the entire industry to abandon the pursuit of raw power and fight a new war for efficiency, measured in tokens per watt, while the financial sector races to build cheaper, blockchain-based IPO infrastructure just to fund it all.
It is a market that has violently matured. The era of cheap money and pure narrative is over. We are now in the era of margins, thermodynamics, and mathematical efficiency.
Which leaves us with a final lingering thought for you to mull over.
Okay.
We spent the last segment discussing how the AI hardware battle is now entirely dictated by tokens per watt, meaning electrical efficiency is the ultimate bottleneck for the future of artificial intelligence.
Right.
So as these tech giants desperately try to secure enough electricity to power the next generation of data centers, how will unpredictable global energy shocks like the U.S.-Iran conflict we discussed at the very top of this deep dive ultimately dictate the winners and losers?
Oh, man. It forces you to wonder if the company with the best chip design will win, or simply the country with the cheapest, most secure energy grid.
Definitely something to think about as you review your portfolio today. Thank you for taking this deep dive with us. We'll be back to unpack whatever the market throws our way next.